Hey, it's Christy. I wanted to take just a few minutes to unpack some information regarding interest rates because it is really going to affect us, our economy, and our cash flow this year. I've had a couple people reach out to me over the last couple weeks and say, hey, while I'm shopping for my mortgage, is there any way that I can go ahead and lock in my interest rate now before it increases in March? And I'm over here scratching my head because rates have gone up nearly a full percentage point as far as fixed mortgage interest rates just so far this year in the first 7 weeks of this year. So there are a couple different types of interest rates. I want to unpack that for you just to have a better, clearer understanding of what we are facing as our rates change pretty drastically this year to help get you prepared. So first, I'd mentioned mortgage interest rates. The fixed mortgage interest rates are tied to the 10-year treasury, and that has really gone up, like I just said, almost a percentage point on our end where we're sharing it with our consumers. So when we were in the very low threes last year, we are now touching 4. So it is impacting buying power. And then when you also increase that with increased purchase prices, the buying power is much different this year than it was last year. So that is what mortgage interest rates are tied to. What is happening in March is the Fed funds What is happening in March is the Fed funds rate is anticipated to go up, and it's actually anticipated to increase 3 times this year, 2 times next year, for a total of 125 basis points increase. So what does this mean? The Fed funds rate has been nearly zero. Actually, it has been 0.08% for several years now. What this rate is what banks borrow kind of on what's called an overnight account. And if it's nearly zero, then banks can more freely borrow money and loan money as well. So it's been nearly zero. This means that interest rates for short-term things will likely go up pretty drastically as well. The prime index rate has been at 3.25% for several years now. And usually when the Fed funds rate goes up, the prime does as well. But let's go back to the Fed funds rate for just a quick moment. The last time that the rate started to change, it actually changed 9 times in a 3-year time span. And with inflation setting in the way it is, and just the costs of living going up so much, we're going to feel it on everything from mortgage rates, on your long-term fixed rates, but also on short-term. So anticipate the APR on your credit cards going up. If you are currently carrying a balance, work on getting that balance down. Maybe look for a 0% transfer offer that's at least 15, 18, 21 months long, and get that locked in if you are in the teens for an APR on your credit cards, because those you can anticipate to go up. Home equity lines are typically tied to a prime index rate. So if the prime rate goes up, then you can anticipate your HELOC or home equity line of credit interest rate to go up as well. So what is it that's happening in March? It's the Fed funds rate that is anticipated to go up. Again, 3 times this year, 2 times next year is just the anticipated change. There's no set marker quite yet that we know about, but I just want to prepare you that everything that you borrow for is about to get more expensive. So my words of advice is, if you borrow money on credit, really do all you can to get that as low as possible. And if you are intending on buying a home or buying a car, the sooner the better, because rates will be going up. I hope this information finds you well. Thanks for watching.